Good afternoon. It's my pleasure to welcome you to another Masters webinar. Thanks for taking some time this afternoon to join us. We always enjoy taking a few minutes with you every quarter or so to give you some insights on what's going on. Gary's prepared today to just give you some data around a number of the topics that are kind of on our minds right now. So Gary, hey, thanks for taking time here to prepare and to pull this together for us. I do want to remind everybody, for those of you who have not been part of this before, there is a section for questions. So we do encourage you, if you have questions along the way, take a couple seconds and just type in a question. I'm going to monitor that, and we'll take a couple stops along the way to just check in, see what questions are out there, and then pose those in front of everybody. So with that, Gary, thanks again, and take it away.
Awesome. Thanks, Lyle, and thanks again, everybody, for joining us today. Always enjoy your attention when we want to give some updates to you on what we're seeing in the markets. And today we're going to have three specific topics for you that focus in on really the main questions that we've been getting from you, our clients, and from others who tend to like to ask our investment opinions over the last quarter or so. And that's really what we wanted to focus on, is what is top of mind for all of you. That means it needs to be top of mind for us, and typically those things are the same. So as an introduction for today, we're going to go through three specific themes of this webinar. The first one is something it feels like we've been talking a lot about for the last couple of years, but we're just going to re-examine the question of, could it be time for a market pullback? We're then going to talk a little about global investing and the geopolitical uncertainty that we've been facing, especially over the last 40 or so days since the war in Ukraine started. And then, of course, I think this is probably the number one question we've gotten here over the last quarter or two. What do we do about inflation? So we're going to talk about those three topics. Again, like Lyle said, when you have questions, send them in. We'll get to as many of those as we can, and hopefully we'll answer some of those as we go through what we've prepared here for you today. So we'll start with the age-old question, is it time? Again, we've been asking this question for years and years and years, and that is not uncommon. One of the remarks we like to make about the stock market is that bull markets, positive markets, don't die of old age. So we're not going to get a recession just because a certain amount of time has passed. And that's very relevant today, because aside from the very quick loss of 30% and recovery about 2.5 months later that we faced in 2020, we haven't had a prolonged recession in the United States since 2008 and 2009. So this question is certainly relevant when we've been looking pretty much at a straight up market with some bumps in the road for the last 12 years. And this shows you what the S&P 500 has done. So the S&P 500 is an index that measures the 500 largest companies in the United States based on their size, going all the way back to 1996. And what we see is the theme that we would expect. We have a cyclical market here in the United States. Our economy is cyclical. We have times of expansion, we have times of growth, we have times of maturity, and we have times of contraction. And then that economic cycle repeats itself. And we see that here with this chart pattern, 96 up to the tech bubble bursting in 99, 2000, down to a bottom around 2002, significant growth up until our peak in October of 2007, and then our trough in March of 2009. And of course, we have the one we remember most recently back in 2020, but we've quickly recovered and gone way beyond that, up now on 105% from the bottom of March 23rd, 2020. And so we really are still in a bull market. Technically, this blip in 2020 would be considered a bear market, but it was so short-lived, even though it wasn't fun at the time for any of us for multiple reasons. It was so short-lived that we're really pretty much still in this bull market that started in March 2009. And even though we've got some choppy waters here this year, onward and upward we've gone to the most recent market position where we are right now in April of 2022. But the economy here in the United States is cyclical. So we can look at some economic data to help inform us where we may be in the cycle. We can't say where we are in the cycle to exact certainty. So if we think about a market cycle being like a baseball game, 9 innings long, it's hard to say, well, we're in the bottom of the 9th inning with 1 out, 2 runners on base, and it counts 1-2. But we may be able to say, we're probably somewhere in the 7th, 8th, or 9th inning of this game, as opposed to being in the 1st, 2nd, or 3rd inning. We can at least get an idea of where we stand, just not to exact specifications. And here's one chart, and really a collection of charts on labor demand that I think we all know, but does point to us being somewhere in the late stages of this economic cycle. We currently have somewhere between 11 and 12 million open jobs in the United States. We currently have just shy of 7 million unemployed people in the United States. So you can do the math. We have about a 4.5 million job surplus currently in our country. And that is something that can slow down economic growth. Of course, if companies can't hire the workers they need to fulfill the demand that they have, we're inevitably going to see a slowdown. We've also seen the worker gain more leverage and utilize that leverage. And we see that here, which is the amount of folks who are quitting their jobs on a regular basis each year, and we're at a peak there as well. So that's telling us the worker has a lot of leverage right now. There are a lot of folks resigning, quitting their jobs, and that means they're going on to find better jobs. They have a lot of options because of this job surplus we currently have. And then the icing on the cake is we're at a low, really an all-time low of layoffs. So even workers who may not be giving the very, very best to their companies aren't getting laid off right now. We need workers, and we're starting to run out of high quality workers for the amount of jobs we need to fill. So this is something we want to keep an eye on. If the labor market continues to be tight, there continues to be a surplus of jobs in this country, that's certainly a sign pointing to potential economic slowdown in the United States. The most recent employment and unemployment numbers just came in here for March, and you can see on this chart, we're now at a 3.6% unemployment rate, which is remarkable. It's a low, I'm sorry, we're right here on the employment rate. As you can see, it's a low for the last couple of decades. We're going back 50 years here to 1971. So lowest unemployment rate we've seen. Typically our unemployment rate bottoms out somewhere around 4%, and the 50-year average is 6.2%. So certainly another factor in this tightening of the labor market, which could potentially constrict future growth here in the economy. The other piece of that is wage growth. We're finally getting some wage growth. You can see back in 2020, of course, wage growth went negative almost. It just dropped off the cliff because of all the uncertainty at that point in time. But very quickly, driven by the labor demand and partly by inflation, we are now at 6.7% wage growth. Now, some of you might say, well, we're net out the same, right? Because inflation's running about that as well, and you would be correct. And that's another sign of saying when we see wage growth peak, as we have in the past, we typically see unemployment bottom in those same periods of time, and that means we may be due for an economic slowdown. So there's certainly some signs that we're toward the end of this market cycle, but then of course the question as investors is, what do we do about that? Do we pull all our money out of the stock market? Do we start investing in different types of vehicles to try to combat maybe a potential economic slowdown? And really our answer at Masters always comes back to what positions are we holding within our investment portfolios. We want to make sure we're extremely cognizant of what types of investments we're holding and how we can expect them to behave in an economic slowdown. And one of the areas that we still think there's some attractive investment opportunities is in the value side of stocks. So stocks are categorized in a variety of different ways, but one of the ways they're categorized is being a value stock or a growth stock. And the way you can think about that is how much money am I paying per each dollar of profit that a company is producing. Typically, growth companies cost more money per dollar of profit than value companies. So in essence, they're more expensive. You go into the grocery store, you're looking to buy a bag of barbecue potato chips. When I'm doing that, I'm ignoring price and going right to Martin's, but some of us may shop around a little bit for the sales. And we might see one bag for $3.99 and another bag for $2.99 and say, I'm going with $2.99. That's the way to think about value and growth. You're paying less for a value company than you are for a growth company. And for that, you typically, over time, earn a more consistent return. And typically, that leads to a higher annual compound return over time. And so at Masters, we like to weight our portfolios more to the value companies and a little less to the growth companies. And what we're seeing right now on this left chart is how expensive is growth, so growth companies, relative to value. And what we're seeing is this long-term average here, you don't really need to know the numbers, but just pay attention to this green line, is the average difference of what a value company costs versus a growth company. And as you can see, we've been well below this average for about 5 years straight, going back to 2017. And we're still at a pretty low point, historically speaking, meaning value is much less expensive than growth at this current time in the market. And so there's still significant opportunity from an investment standpoint, in our opinion, when we look at data like this. The last time we had value and growth this different from a price standpoint was back in 99 and 2000. You may remember that was the tech bubble. Anything with a .com at the end, whether they had revenue or not, was being bought up like crazy. Of course, that collapsed between 2000 and 2002. And through that period of time, the US market as a whole was down about 37%, somewhere in that range, from 2000 to 2002. Value companies as a whole during that period of time were up about 6%. Now, it's not always going to be that extreme, but we are starting to see on the fundamental number side of things some similarities, not quite to the extreme, but some similarities to what we saw back in 2000, and that has us continuing to weight our portfolios toward the value side, those cheaper companies. And this is just one more way to visualize the value versus growth price phenomena that we're seeing right now. All you need to focus on here is the gray lines. The wider the gray line, the more expensive growth is relative to value, or to put it the opposite way, the cheaper value is relative to growth. And what you see is we've got a very wide spread right now of what value companies cost on average versus what growth companies cost on average. And we haven't seen a spread like this that we've had even the past couple of years since that same period of time from 99 to 2002. And so we say, okay, maybe we're somewhere towards the end of this ball game in the 7th, 8th, 9th inning. Maybe we're approaching an economic slowdown. We want to be extremely cognizant of what types of companies we're buying, we're holding. We want to make sure, one, we're buying them at an attractive price, and two, they have the type of structure, both financially and from a business standpoint, that they should be able to withstand an economic slowdown better than a growth company who may be growing revenue very quickly, but not producing a lot, if any, profit to the bottom line. And those are the type of companies we don't want to be holding if we get a slowdown. We want to hold the type of companies that produce consistent profits and can easily use that to buffer the effect a slowdown has on them. So Lyle, on the is it time?
Gary, I lost your audio for some reason. Gary, can you hear me?
You hearing me, Lyle? Any
Yeah, I
questions?
hear you now. Yeah, so sorry, we lost some audio there for a second. One of the questions is back a slide or two. Can you go back to the unemployment slide?
Sorry, Lyle, I'm having a little bit of trouble with my audio. Can you still hear me?
Yes, I can hear you fine now.
All right.
Can you hear me okay?
If you could just repeat that question.
Can you go back a couple slides to the unemployment slide? One more back. Yes, right here. So, no, one forward. Sorry. We'll get this squared away here. So something interesting, an observation on this slide here. It appears that this is the first time, at least back 50 years, where we've had wage growth that was above 6%, wage growth that was up above 4%, and unemployment that was down below. Get my numbers right here. Sorry, wage growth above 6, unemployment below 4. Which seems pretty dramatic here. Do you have any insights on what some of the dynamics are that are causing this?
Yeah, so really what this goes back to, Lyle, is that the worker currently has a significant amount of leverage in the U.S. economy. Because the labor market is so tight, it's difficult to find good workers right now. So if you are a good worker, you have a lot of leverage because you're needed more now than you have been for a very long time. And couple that with the inflation, what we're seeing is employers have significant pressure to keep up with inflation. If you think about it, if you've been used to getting, let's say, plus or minus a 3% raise, really every year for the last decade, which I think most high quality workers have experienced, you've gotten pretty much a net 3% increase in your cost of living because inflation's been close to zero. So your real spending, your raise minus inflation, things costing more, has been positive. But now if you got a 3% raise in 2020 or in 2021, and we net out a 6 or 7% inflation number from that, now I've got less money in my pocket.
Yeah.
And so I think employers are seeing that. They know they need to keep up with that. And it costs a lot less money to keep my existing employees that are doing a good job than it does to go out and hire employees. And that's just exacerbated by the fact that there just aren't a lot of folks out there who aren't gainfully employed right now.
Do you have any insight on why there's not more workers available?
Yeah, it's tough. So the labor participation rate has decreased, meaning we have less of a percentage of workers available to work. And that could be because of retirement. So, we're in the phase of a lot of baby boomers retiring, and we're going to continue to have that for about the next decade. That's a big part of our workforce here in the United States are baby boomers. And so we have more of them retiring than we have new folks coming into the workforce. We have a lot of younger folks who are taking longer to get into the workforce because a high majority now of folks coming out of high school go to a 4-year college. More people than ever go to schooling beyond that to get a master's degree or even go get their doctorate. So we have on both ends of the spectrum a high amount of retirements from the baby boomers and a lower amount of folks entering the workforce quickly, where even 10, but especially 20, 30, 40 years ago, we've had a lot of people coming right out of the high school, entering the workforce. We would have less folks retiring on the other end.
Yeah, that makes sense. Yeah, thanks.
Great. Any other questions on this section, Lyle?
I think we're good. And just a reminder, anything that comes to mind, don't hesitate to type it in the question section there on your bar there.
Great. So the next piece of what we're going to talk about is geopolitical uncertainty. Of course, there's always things going on, but this last month and a half has put it forefront of mind, and just the horrors of war that we're experiencing from afar between Ukraine and Russia. And that's had some ripple effect through the markets, but really not a significant amount. I'm going to talk through a little bit why we think that's the case. But let's just start with the big thing on our minds, that's oil. Russia is, of course, an enormous oil producer. They produce a little more than half of what the United States produces. It dominates their economy. And this is a look at the price of crude oil. Quarter end, it was at $107 a barrel. I think today it's down to about $95 a barrel. It had spiked up above 120, which we hadn't seen since the Great Recession back in 2008. But overall, it seemed like oil starting to stabilize. There will be some ripple effects from a lot of countries essentially not allowing Russian oil anymore. But overall, this hasn't impacted the broader markets a ton. When we look at the U.S. market and we break all the publicly traded companies up into a sector, so that sector might be technology or healthcare or utilities, and another one would be energy. We would think, oh, oil prices are going to have this ripple effect that goes across the whole country, and it makes transportation costs higher. It makes us all paying more money to put gas in our cars. And that's certainly true, but from an investing standpoint, energy as a sector is only about 3.5% of the S&P 500 energy companies as a whole. And so even some ripple effects that oil is going to have directly are not going to have an enormous effect on the market as a whole. The other factor here is, of course, the United States. We have a significant amount of control as to how we approach the oil dilemma. And the one item I want to point out in regards to that, and why I say that, is here in 2020, we see that we produced 18.6 million barrels of oil per day on average, and we consumed 18.2. So we can do the math on that. We had a net surplus of oil in 2020, excuse me. That was the first time in a long time. I'm not going to say ever, because I'm sure there's times way back that was true for us as well. But first time in a long time that we had a surplus. Now, we can see down here that the active oil rigs dropped off a cliff at the very beginning of 2020. I'll allow you all to draw your own conclusions about why that was the case. And so in 2021, we flipped back to having a deficit, requiring us to import more oil than we would have before. But if we look out the 2023 projection, which 2023 is only 9 months away, believe it or not, we're projected to get back to having a surplus. So we'll see what happens. Obviously, there's significant political ramifications with oil and production and all those sorts of things. We'll leave those for another day, but I know we've had many of those conversations with you. But overall, we do have a lot of control over how we handle the oil dilemma. And we're close enough to that break-even line of production and consumption that it shouldn't have a huge effect on the US economy specifically as far as it relates to Russian oil. Here's some more data to back that up. What you see here are two charts. The top chart is the history of the price of oil. And I know these are a little small, but what you see on the left is the dollars per barrel that crude oil costs. And on the right, we're going back to the year 2000. And what we see is we had significantly high oil prices for a sustained period of time from about 2011 to 2014, 2015. We were right up here around $100 a barrel. And I remember there are a lot of rumblings of, oh no, you know, we've had this recovery from the Great Recession, 09 to 2012, 2013. Is the high price of oil going to lead us down the path of another recession? And at least in that point of time, which is zoomed in here, what we see is the S&P 500 pretty much had a steady march upward during this red circled period of time when oil prices were high. So of course there's some correlation of oil prices to the market. It increases transportation costs. It might make us as consumers spend a little less money because it's taking more dollars for us to fill up our vehicles. But overall, historically speaking, it doesn't have a significantly major effect on the market as a whole from what we've seen. And then back to the Russia, back to the Russia element of all this. We also look back at, well, what happened when Russia invaded Crimea back in 2014? And what we see here again is really no effect whatsoever on the S&P 500. So this is the S&P 500 from for the year 2014 when that invasion happened. And as we can see, just not much of an effect on the US market as a whole. And really we're seeing the same thing right now. The market's certainly more volatile, but there's not a significant effect on that from the investing standpoint of things. And we would expect that to continue to be the case unless, of course, this expands into a greater conflict. So what does that mean for the broad global market as a whole from an investing standpoint? What we can see is this year, 2022, year to date, returns right here for each market have been pretty mixed. US down about 3.5%. This is just a couple days old, so it's gotten a little worse since then, and it's a little better today, so on and so forth. But you can see a mixed bag. Emerging markets down about little over 5%, but UK up 2%. Brazil, an emerging market, up 41%. Of course, they got whacked in 2021. China down almost 11%. And essentially, we show you this just to show you that the Russia effect is not significant beyond a little bit in the oil markets, but it is not having really an effect on the rest of the markets as a whole because they started the year in negative territory bouncing around, and the war specifically has not contributed to a shift in the investing landscape. And really the main reason for that, again, from an investing standpoint, is before the war, Russia made up about 1/3 of 1%, so about 0.35% of the entire investing universe. The United States makes up 62% of the entire investing universe globally. So Russia's economy at 1/3 of 1%, it just doesn't have much of an effect on anything globally. And the other interesting tidbit about that is, of course, the Russian economy has lost tremendous value since the war started due to sanctions and all those sorts of things. And right now, Russia's total economy is worth about the same amount of money as Walmart. So the total worth of Walmart is about equal to Russia's current total economy. Just to give you some context for how small a sliver Russia is in the overall economy. Another question would be on China. I know a lot of us have been asking questions, talking about China and what's going on over there. And even though China is a huge country and does have a pretty large economy, it doesn't contribute very much to the overall investing universe. Again, the United States is 62%. The United Kingdom, 4%, contributes more overall than China does. China's about 3.5% of the overall investing universe. And so what's going on over there also doesn't have a huge effect on the global markets as a whole. And so how should we think about investing internationally right now? This is some interesting data on the cycles of how the United States does relative to how the rest of the world does without the United States. And this goes back to, again, 50 years to 1971. And we're seeing the purple sections are when the rest of the world outperformed from an investment standpoint the United States. The gray sections are when the United States outperformed the rest of the world. And what we can see is a pretty consistent pattern. There's periods of time when the rest of the world does better collectively than the United States, especially back here in the late 80s. And then there's periods of time where the United States does better. And that certainly has been the case more here recently since the mid 90s. But especially here, we've now had 14 straight years of the US outperformance. And the main reason for that is in the early 2010s, so 2011, 2012, there were some significant headwinds in the global markets while the United States rode through those pretty smoothly. So of course, we're humans, so we're trained to see patterns. And the pattern would tell us, well, there's going to be some time in the future when we should expect the rest of the world to outperform the United States. Well, let's put some data to that. And just like we looked at in the value versus growth conversation, we want to look at how is the global economy priced from a purchase of stock standpoint versus how's the United States priced. And that's what you're seeing over here on this chart. The lower the bar on this chart, this gray bar that you can follow the downward trajectory, the lower that is, the cheaper international stocks are relative to US stocks. And what we see is we're at a significant bottom in the price of international stocks versus the price of US stocks, meaning that from a pure numbers standpoint, global stocks are a very attractive investment opportunity right now versus the United States. Now, of course, does that mean we should go out and put 100% of our portfolio into the global markets? Absolutely, it does not, but it does continue to make the case for global diversification with still a bias to the United States. So Lyle, that's what I had on the international piece. What questions do we have on that?
Here, I forgot to unmute myself. It's very interesting. You know, it almost seems like the international markets have almost been like a somewhat forgotten asset class. I mean, people still usually have a little bit there, but it's kind of like it's been so long since they've had outperformed the U.S. It's almost been forgotten in some cases. But looking at this data here, Gary, it certainly looks like you could build a strong case for maybe even certainly putting them in your portfolio, but maybe even overexposure to them. So what's your thought as Masters puts together portfolios related to the international valuations?
Sure. Yeah, that's a great question, Lyle. So first, I'll tell you what Masters doesn't do, and you all probably know this, but just to reiterate it, we're never trying to predict what is going to happen next. So our team's not going to sit in a room and say, oh, we really like Brazil, or we really like consumer staples as a sector in the market. What we're going to do is continually evaluate the fundamental aspects of the market and then diversify appropriately based on those fundamentals. What that means right now is that we will continue to look at the fundamentals in the US stock market and say, we think there's good opportunity in value versus growth. So let's take our portfolio and tilt it a little bit to value. We might say, oh, we think there's some good opportunity in certain global markets. So let's take our global position and tilt it just a little bit to some of those factors. In investing, we never want to go to extremes, because if we go to extremes and say, oh, we should be all global, we should be all US, we should be all stocks, we should be all cash, we have to keep making the right decision over and over and over and over again. And even the very best money managers are really, really poor making the right decision over and over again, because the stock market as a whole is too multifaceted to predict. There's just too many factors. But what we can do is we can look at the fundamentals of the market, and we can be smart about how we're diversifying our portfolios based on the fundamentals that we see. And so the example in the global piece specifically is the dynamic rebalancing strategy that we have in our portfolios. And what our rebalancing strategy does is, when the US market does really, really well, we get the benefit of that for having that in our portfolio. But the global market lags a little bit. And so when that gets to a certain point, we just sell a little bit of our US stocks and buy a little bit more of our global stocks, because there's opportunity there. We're not taking 20 or 30% of our position and moving it. We're taking a couple percent here and there with a rules-based strategy, not us sitting around in a room taking guesses at what's best, but a rules-based strategy to, over time, essentially sell high and buy low. And so that's what we would see in our portfolios here recently, is taking a little bit of our profit from positive US performance and deploying it in what we think are some attractive valuations in the global market, but not to an extreme scale.
Good. Gary, we have another question here related to bonds. We didn't get into that too much, but a question about how bonds, kind of the role they play in a retirement portfolio, and then what's our thoughts about performance in the next 2 to 3 years, especially if we think there's going to be some inflation. I know the next section's inflation, so if you want to deflect some of this to later in the conversation, maybe that will work as well, but wanted to throw that question out there.
Yeah, great question, extremely relevant, most relevant for our retired clients. And so we are going to cover that, but if I don't cover it adequately, we can come back to it in this next section. So I think with that, Lyle, let's jump in to inflation. I think we saved the big one for last, because this is the question we've all been asking here for the last year or so. What do we do about inflation when it comes to how we allocate our portfolios? Here's where we stand right now with inflation. Headline CPI about 7.9%. Now, we are aware that with the inflation numbers and with the unemployment numbers, there's a lot of different ways we can slice and dice these numbers. There's a lot of different ways the various reporting agencies choose to report these numbers, and it might hide some things. But for our purposes today, we're just going with headline numbers, even though we do understand there may be some inconsistencies in there. But just to give us a point of reference, headline CPI 7.9%. That's the same as food. So I'm sure we've all noticed our food costs going up 7.9% year over year, energy up 25% year over year. And so we're seeing inflation that we haven't seen really since all the way back in the 80s. We were up here with 15% inflation. But of course, at that time, you were also getting 16% on your CD at the bank, while you're also paying 18% on your mortgage. So it all kind of follows together. But right now, there is some dislocation because we have this very high inflation, relatively speaking, and we still have relatively low interest rates. So it does produce a unique challenge from an investing standpoint. And this is the chart that illustrates that right now interest rates, and this is just the 10-year US government treasury bond. It's at about 2.4%. That was a few days ago. Today it's up above 2.6%. It's gone up significantly, as you can see here, just over the last year. But when we take inflation out, we get what we call a real yield. Your real yield is your interest minus the inflation adjustment. And look at this, our real yields are down at 4% if we're holding US government bonds. And what we can see again, we haven't seen that to a significant degree since back in the 70s and 80s. So there's a lot of talk about we're going to hit what we call the stagflation period, where interest rates aren't keeping up with inflation. And certainly that is possible. And we're seeing some signs of it right now. So what has that meant for the fixed income markets? If I'm a fixed income investor, where do I go? Because this year in 2022, I have had absolutely nowhere to hide. Logic would tell me, well, inflation's high, so I'm going to buy inflation protected bonds. And that's not an unreasonable conclusion to make. However, this year, inflation protected bonds are down 3.5%. They've actually underperformed the 2-year treasury bond, only down 2.7%. I know some of you might be asking, well, why is that? Don't these inflation protected bonds automatically give me the inflation number? You know, they're much more complex than that, but the key component of an inflation protected bond is that it's still a bond. And when prices go up for bonds, yields go down. When yields go up, prices go down. So we've had increased rising interest rates. Prices have gone down in bonds. A treasury inflation protected security is a bond, which means it's got hit in price here so far year to date. And then if we go down to away from government bonds and to maybe some corporate bonds or some other things that can get us more yield, we can see we've also taken a pretty good hit on all of those. The key lesson here is that when rates go up, your shorter term bonds don't lose as much value as your longer term bonds. You can see that pretty clearly on the government side. A 30-year government bond down almost 12%. Almost hard to believe a bond could drop that much, but it's been a while since we've seen a rising interest rate environment like the one we're in. Almost 12% for a 30-year bond, about 2.75% on a 2-year treasury bond. And again, this is year to date. We're only a little over 3 months into the year. It's a very short time horizon, but certainly it's been painful to be a fixed income investor in this current environment. And so we want to go back to the principle of fixed income. We might look at this and say, why would I hold bonds at all in my portfolio with the performance that it's been? And that's a relevant question. But will we continue to revisit, Masters? Why do we hold fixed income in the portfolio? It's to act as a ballast to the portfolio. It's to act essentially as your hedge against stocks. Now, again, in this year so far, that has not worked out. Stocks and bonds are both down, which is pretty rare. It's a pretty rare environment. But the way we can see, hey, are my bonds going to act as a position of safety in my portfolio if stocks continue to struggle? We need to look at, well, how correlated is their return to the US stock market? Correlation is relatively simple to understand, hopefully with my explanation. Essentially what correlation is it looks at two investments and says when one goes up or goes down, how much does the other mirror the up and down nature of that investment? And so if two securities move exactly in line with each other, they would have a correlation of 1. If two securities are all over the place, there's really no relationship to each other, they would have a correlation of 0. And if two securities move exactly in opposite forms, one goes up, the other goes down in perfection, would have a correlation of -1. So 1, 0, -1. So what we want in our bonds is we want negative correlation to the US stock market. And when we look at the bond universe, there's only a few places where we get true negative correlation, and it is in US government bonds. If we go in even into Treasury or into Treasury inflation protected securities, they're going to do a pretty good job, but they don't have that same correlation factor. They're actually positively correlated to the US stock market. And then if we go down into some of the less traditional fixed income sectors, we're getting almost all positive correlation with one outlier here, which is mortgage-backed securities. And that's what we really have to watch out for. We need to be careful in this fixed income environment is that we don't overthink it and effectively increase our risk in the portfolio by owning fixed income that's more like a stock and less like a bond, because we need our bonds to be a ballast to the portfolio, even if in the short period of time they have not done that. Our temptation is to chase something else. We have to be really thoughtful about if we want to do that, and if we do, how we do it. This is another way to look at the same thing. A lot of colors on this chart. All it's showing us is different types of fixed income and how they're performing, ranked from best to worst. And what you can see here year to date, our best performing fixed income sector is down almost 2.5%. It has not been a great time over these last 3 months to be a fixed income investor. But if we take a long lens, which we always want to do, and we always do with our portfolios here at Masters, what we see is that this white box is an asset allocated portfolio. So that's all of these different types of bonds put together in a portfolio and allocated appropriately for diversification. What we see is that asset allocated portfolio over time is what gives us consistent fixed income returns. And that's what we're looking for in our fixed income. Consistent returns over time that act as a ballast to the portfolio. So another question related to this would be, okay, well, I still don't like fixed income. What are my other options? Where else could I invest that helps me to fight this inflation monster? It seems like we can't control it, and seems like we have no options because fixed income has let us down for the first 3 months of this year. Well, this chart shows you a number of different investments, what their yield is, so what dividend they pay, and how correlated, remember we go back to correlation, they are to the US stock market. So the further you are on this side, the more like a stock these types of investments are. And down here, the more like a bond you are, where you act as a ballast to the portfolio when stocks are down. And then on the left side, we have the yield. And what we see is that we have a linear relationship. The higher the yield, the more stock-like the investment. The lower the yield, the more bond-like the investment. And so if our goal for our fixed income is to be a ballast to the portfolio, we need to stay down in owning things that are actually bonds. Because we would say, well, if we're going to own some of this stuff up here that's kind of a bond but more like a stock, we're much better off from a risk reward standpoint simply owning stocks. Why would I own a bond that's like a stock when I can just own a stock? And that's our philosophy at Masters. If we want stocks, we're going to own stocks. If we want bonds, we want to own bonds. And we put those together in an asset allocated portfolio. And so what's the punchline to this? The punchline is, from a data perspective, the best hedge against inflation consistently are high quality stocks. You hear a lot of different ideas about hedges for inflation, and some of those hedges do work in short periods of time, but over time, the most consistent hedge against inflation are high quality stocks. This is just an example. This is a particular investment strategy that invests in value, high dividend U.S. stocks, so quality companies, good earnings, attractive price. And what this is showing you is the orange is the inflation rate going back to 2005, and this green line is the total dividends that this portfolio paid. And what you can see is over time, there are very few examples other than this most recent blip that the dividend on a high quality US stock portfolio has not outpaced inflation. And one more way to put this, I know this is small, but essentially what this chart shows is the return of stocks, which are the green bars, annual returns, and the inflation rate. And what you can see is over time, these highs for stocks well outpace these highs for inflation in the red. I'm just going to zoom in on this very last point, and then we'll go to some questions. That over this charting period, the S&P 500, so collection of companies, U.S. stock market, returned 8.1% on average per year, adjusting for inflation. And if we go back all the way to 1926, the annualized inflation adjusted return for U.S. stocks is 7.3%. That's after inflation. And so if you invest consistently in high quality stocks over time, that's typically going to be your best inflation hedge. And so with that, I know we've got a couple of questions, and I'm sure there's some questions here on the inflation, fixed income stocks. So Lyle, I'll kick it to you for what we want to tackle first.
Yeah, just got a question in about your thoughts about increasing stock exposure. If stocks are such a great hedge against inflation, and we're thinking inflation might be here for a while, does it make sense to increase your stock allocation in your portfolio right now?
Yeah, that's a great question, and that's a reasonable conclusion to what we just looked at. And our opinion here at Masters would be that could be something to consider as long as you're a long-term investor. If you are a long-term investor, you want to be in stocks. Not necessarily 100%, especially for those of you who are retired, but stocks are going to, over time, not in every single time period, but over time, outperform bonds, outperform cash, outperform gold, whatever else you want to throw on the table. And so it's not an unreasonable conclusion to draw, but I would say, Lyle, it really depends on what sort of stocks are you investing in. When we get somewhere toward the end of a market cycle, what we see typically out there in the universe is that investors tend to increase their risk the closer we get to the end of an economic market cycle. So we also have to keep that aspect in mind. And we would point that back to our dynamic rebalancing strategy, just like we talked about with US stocks versus global stocks. We do the same thing with bonds and stocks. So if we have a period of time where stocks are down and bonds have held water, we might trim some of the bond position and buy some more stocks. Again, buy low, sell high. And so we want to do that all within a reasonable framework. We don't want to go 100% stocks. We don't want to go 0% cash if we are counting on our investments in retirement. But certainly we can consider maybe how are we allocated in the current environment with the money that we need.
We have a follow-up question. Thinking from a retirement perspective, somebody who's in retirement, what do we consider long? Like when we say long-term investor, what's that mean in number of years?
Yeah, that's a fantastic question. And the way we typically define that is if you have gone through our retirement planning process at Masters, what you know is that we use a bucketing approach to allocating assets in retirement. What that means is we're going to take all the investable assets you have, we're going to build you a customized, personalized retirement plan that we call retirement income architecture, and we're going to break that into a few slices based on your time horizon for those buckets of money. And what you're going to end up with is you're going to end up with some of your investments invested very conservatively for the money that you're going to need in the next, let's say, 5 to 10 years. And then for the money that you don't need for 10 plus years, we can invest more aggressively because we know we have time to withstand the volatility of stocks. And so we use a bucketing strategy for that. And that applies to investing in fixed income too. We've been lulled to sleep a little bit with fixed income. We haven't seen negative returns like this year for quite some time, but it can happen. And our philosophy typically at Masters is if you need money within 18 months or less, 18 to 24 months or less, you should just have cash, because there are periods of time where bonds can be negative for a year plus. And so if you need that money, if you need cash, have cash. If you have some time, or if you're just taking a small portion of your portfolio on a consistent basis, you can be invested in a stock and bond portfolio. So what I would go back to, Lyle, is we want to assign a purpose to each piece of the portfolio, and then we can invest differently based on the purposes of each piece.
Yeah, that's great. Thanks, Gary. We have a few other questions that we didn't get to answer, but I do want to be cognizant of the time here. We want to be committed to an hour here. So if we didn't get to your question, we do have those recorded, and we can follow up with you individually after the webinar. So thanks for your participation, and thanks, Gary, for your work here with us.
Yeah, and Lyle, I think we've got time for one or two more if you want to hit me with those.
Well, there's a couple more complicated ones. I think it's going to take more than a minute or two to hit them. So I think we're better off just probably following up.
Let's finish it up with one last one.
Okay, so there's a question related to digital currency and the dollar. So any final thoughts with that one?
Wow, great. That's a great question. Yeah, so obviously that's a multifaceted question. And I think the question there revolves around, right now, the US dollar is the reserve currency in the world. Any concerns about that not happening anymore? And that's certainly possible. Right? Anything's possible when we look out into the future. One of the interesting studies that I researched on that exact topic looked back in history of all the different times that there's been a threat of the dollar maybe not being the reserve currency of the world anymore. And if you look back in history, it's happened multiple times every decade, all the way back to when we have data. And so what we tend to believe here at Masters is the United States makes up 62% of the total investing universe. We're one country, and we make up 2/3 of the entire investing universe. We believe America will continue to lead the way in that regard, and tend to believe that the dollar will continue to hold out in that way. If it does not, it will likely be a very gradual shift. We'll see that in the data, and at those times we'll be able to figure out how we maneuver it. But it's a great question. I think it's tough to have a firm conclusion on it, so I apologize if I don't give a direct answer on that, but that's how we would view it at this point in time at Masters.
Good. Well, I think that that wraps up what we had planned today. Thanks again, Gary, for all your work with this.
Yeah, thanks again, everyone, for being with us today. If we didn't get to your question, we'll go back and we'll answer those questions directly with you. If you have other questions, of course, always send them our way. We're always here. And thank you for your trust in us and in our team at Masters. It's a privilege to serve everyone. Have a great evening.